Hello everyone and welcome to another edition of Emkay Macro Market Moves. Today we have with us the Chief Economist at Emkay Global, Ms. Madhavi Arora, and we're going to talk about basically everything that's been going on in the world over the last 2 or 3 weeks or so. We're in FY26 now, April of 2025, but the start to the financial year has been extremely chaotic, extremely volatile, and it's been led by obviously all of the tariff noise that's been emanating from the US. And we'll just try and break down a little bit of what we can, because obviously it's all up in the air. Even as we're recording, China has announced further tariffs on the US as we speak. So it's all extremely volatile. A lot of it is still up in the air as to how things will pan out. But to start the discussion, basically, I want to talk about what's been going on with tariffs. Obviously, Donald Trump has announced a 90-day pause on reciprocal tariffs on countries, but he's ratcheting up the trade war with China. So, Madhavi, we've seen, as I said, a lot of chaos over the last 2-3 weeks or so. There seems to be, the market seems to think that there is now a bit of a pause for the next 3 months. First of all, do you think this is likely to be the case, or there is a lot more volatility still to come? And secondly, from a broader point of view, just, what impact do you think these tariffs are going to have on the US specifically, or even, on the globe as a whole?
So we are in a very interesting geopolitical situation. It's very difficult to say where the end game lies in this whole process. One thing is clear, that America realizes that it's a tariff tax which actually end up hurting it much more. That's why we saw some kind of retracement from Trump. But at the same time, the war is now becoming much more US-China centric, right? I mean, they both are basically, the trade between these two countries is dead. Whether it becomes 100%, 150%, 200% doesn't matter. The moment it crosses 50% or above, it's basically a dead trade between these two countries. Now, given the fact that he has sort of, given a 90-day relief to certain countries, or probably that could become a new permanent, where 10% would be the new tariff for the rest of the world, we might actually end up seeing the same China plus one thesis that played out in 2017-18, when it was a US-China-led war. And China found transshipment through the rest of the world, found new ways to innovate, new ways to be relevant in the new trade order or the new export chain, and of course finding FDI route, via ASEAN and even LATAM. So, more of that could still happen. It could also lead to a lot of trade renegotiations among nations. Asia could be a great trade pact. But again, America still remains a very important player. Even though it gets hurt in the process, it also hurts everybody around the US, because it's a very important trade partner for everybody in the world. It's the biggest consumer in the world. So even if we assume the US is, doing basically a self-hurt, or basically a situation wherein they're hurting themselves in some form or the other, it is eventually going to hurt everybody around too. So you are in a trade war where there are no winners, not even relative ones. So I don't know where the endgame is, as I said, but clearly you are in for a very chaotic period, which could lead to a new equilibrium. So we will only know how it pans out and how long this sort of gets dragged. But we are in for an uncertain time, which is not good for a global economy in general. It's not good for investment decision. It will hurt consumers eventually, and it would lead to a deadwood loss in the world order, and will eventually be a situation where stagflation, which is the current new phenomenon that America would end up facing, for a good quarter or 2 quarters, could lead to a permanent loss of output, which could eventually mean a disinflationary impulse that will come out of this destruction of demand. But we'll see how it pans out. As of now, too early to really ascertain where the cycle lies, but it's a messy one.
Yeah, exactly. And another interesting thing is that obviously Trump has paused these tariffs for 90 days, apparently on the back of how the US bond market has reacted, how the US treasuries sort of yield spiked. So long-term bond yield spiked by almost half a percentage point or even more in the space of just 3 days. And that is apparently what led him to pause these tariffs.
Correct.
Now, we've seen the DXY now going below 100 today after these new tariffs by China on the US were announced. So all of this obviously has massive implications for emerging markets, including India, but broadly as an asset class. So in general, as just to extend the discussion that we were having earlier, how do you think these tariffs are going to impact US bonds, probably currencies as well? And then of course, the way in which that could flow for emerging markets.
So I think US is exhibiting a very interesting trend. You are seeing dollar weakness at a time when people are expecting recession, which will be led by US. At the same time, bond yields are actually soaring, which again is very counterintuitive to think of, because when you look at economies, going into a slump state, the logical trade is to basically move away from equities to a safe haven, which is US treasuries, right? And as you said, treasuries have actually soared in the last 10 days or so. As we speak today, they're still above 4.4. They had touched close to 4.5, if I recall, pre this pause. And even though we saw some respite in bonds, it's still pretty much a very sticky 4.4 plus level as we speak today. So I think the two things with regard to US Treasury market, I think there's a structural pain in the Treasury demand supply. The dislocation in the bond market is basically emanating from that bit on a more structural basis. On a more near-term basis, of course, there were a lot of technical positioning that played its part. There were unwinding of certain hedge fund related basis trade positioning, which may have led to this instant spike or recent spike in the bond yields. But in a more structural way, if I look at the US bond market, there's a clear demand supply mismatch. And if you look at the structure of the bond market there, right, the supply looks to be still very heavy. US sitting with 6% fiscal deficit, despite the fact that the economy has been growing above trend. The policy response on fiscal side has been expansionary. The supply has been on a net basis pretty heavy. The debt is a problem in the US on the general government side, and thus the supply is a constant problem. Now, assuming that the US does get into a slowdown or a recession, we'll have to see how deep it goes and what the policy responses would be. But assuming there's a slowdown, there is going to be a counter-cyclical policy response from fiscal side as well, which will imply that the fiscal deficit may either remain 6% or even go higher, which essentially implies supply would be again a problem. That's one part. Now on the demand side, if you look at, a decade ago, 50% of the US sovereign debt was owned by foreign investors, which has gone down to nearly 30%. There's been a structural fall in the demand of US treasuries as a global play. Apart from that, even those sticky players in the domestic markets, basically the Fed and even the banking institutions, they also have withdrawn on net basis. Fed is already on a QT phase, even though the QT has slowed, but it's not buying bonds. It's still on net selling bonds. And banks also have been shying from investing, and they're the biggest player in the domestic market. So, financial institutions, Fed, foreign investors, all of them have basically seen a structural decline in the demand for US treasuries, and thus the demand supply mismatch actually shows a dislocation, which is going to be the problem, even though US may see a slowdown. Recession is a very different beast. Then you see a Fed coming and really buying bonds. But in a slower growth scenario, I think logically you would still see bond yield in the US not necessarily going below 3.5%. And we've been saying that for a long time now, that term premium will become the biggest driver of long-term yields in the US. So that I think is one problem that the economy is facing. Interestingly, dollar is also weakening. So ideally a higher bond yield should have attracted more flows in America, which is not happening because of either geopolitics or whatever. But dollar has lost its sheen in the near term. I'm not sure how long will that last, because historically dollar has been an anti-cyclical bet. Whenever there's a slowdown, dollar sees a smile emerge. We'll see whether that plays out or not. There's a lot happening in the global order. I still believe that dollar may not see a demise that people are talking about. But as of now, as we stand today, there's a clear DM FX play which is happening, which is anti-dollar, pro-euro, and pro other DM currencies led by Swiss francs of the world. So that is playing out. Emerging markets, on the other hand, are not enjoying a weakness in dollar. Ideally, a dollar weakness should have led to a higher demand in emerging markets. Historically, we've seen dollar and EMFX or EM equities have generally been having a negative correlation if you see a 25-30 year period, which also hasn't played out. So, and that has actually broken post-COVID. The EM, DM, FX play doesn't necessarily have to go hand in hand. So there have been times the dollar has weakened and emerging market haven't really performed as much, which again has played very in the same fashion as I was talking, because we saw dollar weakness, we didn't see necessarily an emerging market FX play. That's also because we are in a very uncertain period, and EM as an asset class is a high beta play, which again requires a higher risk premium, and which is a problem that emerging markets in general face. People may have a different play between EU and US, but they would not go and touch an emerging market, and especially at a time when China is, the epicenter of all these problems, biggest EM that you can think of, and China has massive trade relations with all of its Asian partners. So if China also sneezes, whole of Asia goes for a toss. That also would catch a cold. So I think that's also one fear that people have, that even though emerging market ex China are better placed on tariffs, there's a very high codependency. So there could be a differentiating EM and DM FX play that could continue. But very interestingly, what we are seeing at this point in time is a behavior of US assets wherein dollar is weakening and yields are actually soaring, and yet there are no takers for bonds or takers for dollar.
Which is quite similar to how EMs normally
Correct.
behave. So now coming to India, obviously with the tariff pause coming in and a reciprocal tariff rate of, or rather a broad tariff rate of 10% being applied to all countries, including India, we've obviously done some work where we've calculated that the loss to Indian exports would only be about $6 billion next year, which is less than 0.2% of GDP. And for context, India's exports to the US are 2% of GDP. So it's a very small hit if, as you said earlier, if this is the new reality, if the current pause extends and becomes, the tariff rate that the US applies. So in that context now, we've also obviously seen the RBI cutting rates a few days earlier. The RBI cut the repo rate by 25 basis points further, second consecutive rate. But I would think more importantly, the change of stance was from neutral to accommodative, which has a bigger signaling effect, right? Now, obviously, the tariff pause came after the RBI's MPC. At the point of the MPC, we were still facing, say, heavy tariffs or so on and so forth. Extremely uncertain world, obviously, but if you could just shed a little bit of light on how you see monetary policy domestically, so obviously how the RBI will sort of react going forward, and also fiscal policy, because along with the RBI now, the government has also, on the other hand, it is contracting the balance sheet. It is, we are seeing fiscal deficits come down lower than, the government's own estimates year on year now. So how do you see the two of these sort of interplaying along with, the sort of global chaos that's going on?
So for emerging markets, again, as I said, it's a very difficult play, right? For central banks as well. While logically you would see accommodative policy making across the globe if there is a recession in the world, emerging market in the first leg of that chaos tend to have a very difficult, reaction function. Because on one hand, they need to also support domestic growth. On the other hand, they have to ensure that there is no financial sector disruption that sort of flows into their economy via global disorder. Because they need to manage sentiments, capital flows, which also requires some kind of a higher risk premium for any foreign investors to come to these countries and invest at a time when there's a lot of uncertainty. So then they have to also offer a very good risk premium to investors, because currency is also at a risk of erosion. So it becomes very difficult for them to manage, these dilemmas or trilemmas that people talk about. I think as of now, RBI also realizes that even though they would want to offer a higher risk premium to the global market, there may not be many takers for emerging market just because of the delta that they're giving. On the other hand, we've always discussed this thing in the past also, that India is a more growth play than a rate differential play. Domestic players, in our understanding, have been absent in India. We've discussed that in an earlier podcast as well, where we talked about absence of private economic agents, be it consumption or investment. The only lever which was working for us was exports to some extent. Especially post-COVID, exports were actually the biggest contributor to the growth story, right? Manufacturing export did very well. Services have outperformed in a massive way, both services of the software sector and non-software or non-conventional GCCs of the world. They have surprised on the upside. Every year we've seen only upgrades in these. Even this year itself, I think IT services, even after having seen some slowdown, still growing at around 9% on export revenue basis. And GCCs are still growing 30% plus, even after a very high base year. So exports was a very strong lever for us. Last 1 year has been relatively neutral, but we were not expecting it to be an incremental negative. Now exports will become a drag for us as well, right? So for India, this whole tariff tamasha is actually not only leading to a slower growth, but also probably leading to a lower inflation. Growth, as I said, domestic agents are absent, external agents are becoming, a little uncertain. So there is a little excitement with regard to the growth story. We can be relative winners here and there. But just to note, if you look at India's cycle with emerging Asia, take a 25-year, 30-year cycle, we've never outdone emerging markets in terms of direction. We may outdo them in a growth cycle, both on uptick and downtick, on downturns, but the direction has never been very different. So it's really silly to assume that we are a domestic demand economy, we don't have too much exports to the world, and thus and plus our tariffs are lesser. Now then it's all equal for everyone in Asia except China, but we may be less hurt, which may not be the case. We may be less hurt possibly, but then we don't have domestic levers working. So that's one part. The growth is going to be, tariff is going to be bad for growth. Now for inflation as well, right? For US, it's a tariff tax. They are putting a tax on themselves. While they're trying to penalize the world, but the first hit comes to them, right? The tariff tax hits the industries, it will hit their margins, it will hit the consumer who's the end buyer of these goods. So it's America which will be the first hit in this process. For countries like India, who are also net importers of goods and exporter of services, for us, this kind of a scenario where China's market, China's biggest market is actually non-accessible to it. It will start looking for new avenues to dump its industrial capacity. And minded, China invested massively over the last 5 years, not only on the finished goods of mid-segment or low-segment labor, of course, even high-end they've done, but they have a massive industrial capacity across strata of manufacturing goods, whether it's low-end, high-end, or medium-end. They will look for new buyers. They might end up playing the currency card, or they would actually just slash their margins and just play the volume game. Either ways, the world will be dumped with more industrial capacity than it required, which will lead to a disinflationary wave in the world ex-US. And India would also benefit / lose from that, because our companies will also get hurt. The companies which are exposed to commodities in a different way, the ones who are commodity importers actually gain from this. But on net, it also indirectly or directly hurts our industrial capacity. But at the same time, it leads to a massive inflow of goods for us at a much cheaper rate. And we are a net commodity importer as well. If China slows down, there's no doubt that the commodity prices will also sort of ease. China is not only a producer, but also a massive consumer of commodities. So that, of course, will imply that for us, tariff is actually a disinflationary impulse. So policymakers have taken that into account. They've reduced the growth picture by 20 bips from 6.7, they're looking 6.5% growth now. And inflation has been downticked to 4%, 4.2%. I think growth would see a further downside. As I said, we don't know how long stretched or how deep or bad this cycle could turn out to be. But definitely 6.5 looks to be a very optimistic number, especially when export will be probably a negative play. Inflation, on the other hand, could also see a mild downtick from this number. So this actually augurs well for a central bank, keeping everything else constant. These two variables that they are supposed to immediately see are looking to suggest that they have policy space to ease, right? At a 4% inflation that they are forecasting for a year ahead as an average, they may easily go to a 5.5% on the terminal repo rate, which could still give a 1.5% real neutral rate if they want to find that as a new terminal point. It could even go lower. Our base case is that if recession comes in the world and we really see a massive hit in the global cycle, you could even see a sub 5 as well. But we'll see how it pans out. As of now, it's 5.25 terminal rate plus minus 25 bips here and there, depending on the global cycle. If the recession is averted, then maybe we won't even go below 5.5. And they had to give direction to that, right? Because the first leg of pain will come from the financial market flow. The trade route will play its part in a more medium term, but the first leg will be the impact via the financial sector route, or financial market route rather. And they need to ensure the financial disruption is taken care of. And that's why they talked a lot about liquidity management. The immediate hit of any kind of risk aversion is on liquidity. They have ensured to keep liquidity ample, and that's one thing that they'll keep in handy as we get into the new year. We'll see how FX management really plays a role in that. If China's currency actually gets into a devaluation mode, then all bets are off. Everybody will try to chase that. Then we'll see how it pans out. As of now, it's still a two-way management of currency, wherein they're seeing whether they need to manage on the downside or on the upside, depending on the flows. As of now, obviously, the bias is in downside because now it's very clear that it's a US-China war where yuan would be eventually used as a weapon by China. And all the Asians who have exposure to Chinese market indirectly or are competing with China in the global market will have to play the yuan card along with yuan. So we might also become a residual of that, and we might have to weaken our currency in some form or the other.
All right. Thank you so much for being here, Madhavi. As always, extremely insightful and illuminating in trying to sort of break down all the chaos that's going on in the world right now. Please do subscribe to the channel, like this video if you liked it, and stay tuned. We'll be back with a lot more updates because there's a lot going on in the world right now.
Thank you, guys.